Hello and welcome to BQ Prime. You're watching IPO Adda, and the company focus is Elin Electronics Limited. It's an electronics manufacturing services company or a contract manufacturer for electronic equipment, which includes LEDs, small appliances, fractional horsepower motors, and other services. And joining me is Sanjeev Sethia, who is a whole-time director at the company, and Akash Sethia, who is the head of strategy at the company. The company's IPO opens on December 28th. The price between 234 to 247. It's a fresh issue of 175 crores and offer for sale of nearly 300 odd crores. And gentlemen, thank you very much for joining us on BQ Prime.
Pleasure.
Let me start with
Thank you so much. It's my
Akash.
pleasure.
Akash, if I'm not mistaken, you were planning to come out with an IPO size of what 760 odd crores, and it came down to 475 crores. So what was the reason for it?
Given the slight change in market conditions, we just decided to be a little bit more prudent. We feel that there is tremendous growth potential in the company. And a lot of these selling shareholders decided to retain stock to monetize probably at better levels. Given these two scenarios, we decided at this 475 crore kind of number.
Mr. Sethia, you are into this electronic manufacturing services industry, which is a very competitive one and a very margin pressured one, I would say, because you have good, healthy competition in contract manufacturing, but your OEMs, get the margin, and your margins are roughly around 7% if I look at it. How easy it is to maintain that kind of margin uh, of 7% in this industry?
So it is a very competitive industry, and definitely, we also have to be on our toes if we have to maintain these margins. So the couple of things which help us maintain these margins. Of course, the first thing is most of our products, our model for as far as product costing is concerned is cost plus. So we retain our conversion percentage. So even if there's a change in fluctuation in the bill of material, that is passed on to our customers, and that's a primary reason why we've been able to maintain our margin for last many years. But still, there is competition, and people are looking at more efficient ways of manufacturing. So we have to be constantly looking at innovative ways of how we can cut down our costs, so to take care of all the increase which is coming in terms of not only the bomb, even in there's a general inflationary trend, so you have your salary wages increasing. So we have to be in the lookout for the latest technologies and keep on working on our efficiencies and improving our throughput and improving our productivity.
Mr. Sethia, you are have you do contract manufacturing as well, and you have the ODM business as well. How does that work in terms of margins? You get a higher margin for an ODM as compared to contract manufacturing that you have to do for clients?
So since in ODM, the complete design responsibility and the product design, sourcing, everything rests with us. In general, we are able to derive anywhere between 100 to 150 bips higher margin as compared to, let's say, a purely OEM, where the complete ownership of the design and sourcing rests with the brand. So yes, we are able to derive a little better margin in ODM products.
Akash, what is the kind of levers that you have in your company to maintain this 7% EBITDA margin? I say this because your other competitors have a lower margin profile, and you have 7 odd percent, which is a good healthy margin for this business to be in. And as Mr. Sethia spoke about the fact that you have a cost plus model, is it there for all the all the clients for you, or only for some clients? And uh, the escalation of cost plus, does it include all the inflationary costs that we see normally getting passed on to the consumer? Because at the end of the day, we don't see OEMs able to pass on this cost to the consumer significantly.
No, so two parts to your question. I'll just answer the first one before. So to your point, and how we are able to maintain our margins between 7.5, 8%. The biggest reason I believe is our backward integrated nature of operations. which essentially means that most of the components and sub-assemblies required to manufacture the end product are produced by us internally at our facilities itself. We are not mere assembly operation people who buy components from outside and just assemble it. We are a true manufacturing company that produces most of the components and sub-assemblies in-house, resulting in a better margin profile, a higher return, on our capital employed, and overall, believing in the concept of delighting our customers, right? To the second part of your question, where you mentioned, how are we able to pass on, raw material prices even in inflationary scenarios? We are very clear with our customers that we work on a cost plus model. The bill of material is completely to the account of the customer. And we ensure that any and every raw material price is passed on to the customer. It could be with a slight time lag of a month or a quarter, but it is definitely passed on, which also reflects in our margins. If you look at our margins over the last couple of years, even in a high inflationary scenario, we've been able to maintain our margins.
So you coming out with a fresh issue of 175 odd crores. What is the proceeds going to be used for?
So of the total 175 crores, broadly 90 crore rupees is going to be used to repay debt. 40 crores is used for fresh capex, and the balance is general corporate purposes.
Okay. What kind of capex are you looking at? Because for the last 3 or 4 financial years, you've been incurring capex, and I think currently there is one underway in Ghaziabad, and you have 2
Correct.
land parcels coming up in Bhiwadi and
Correct.
Noida. So, what is the outlook for the kind of capex that you have and the capacity that you're looking at?
So broadly, I think over the course of the next couple of years, we don't expect to incur more than 60-65 crores of incremental capex from today. So like you rightly mentioned, the bulk of the capex has already been done over the last 3.5 years, where we've almost spent 100 crore rupees. So incrementally going forward over the next couple of years, we don't expect to spend more than another 60 odd crores.
Mr. Sethia, given the kind of manufacturing plants that you have currently, 3 under in India, if I'm not wrong, it's in Ghaziabad, Baddi, and Varna. What is the kind of capacity utilization of those plants? Is there enough capacity to take it up over the next few years, or you need to add brownfields to those capacities?
So currently we are operating anywhere between 70 to 75% of our capacity, and this is on a single shift basis. So if the need requires, if the demand goes up, we are always able to run second shifts and take care of the requirement. So currently the way we are placed in terms of the basic capacity, since we've already done some expansion in terms of our infrastructure, both in Verna and Ghaziabad, we are primed to take care of our requirements for the next 2 to 3 years. And we might need some general investments based on certain specific projects, but the investments and the infrastructure is in place to take care of the requirements for the next 2 to 3 years.
What's the kind of mix that we have between OEM and ODM revenues?
So first of all, I mean, the way we define the OEM and ODM business is just for the complete products which we make for the brands. So for example, like our motor business is completely ODM because it's an intermediate product. So we don't take that into account to define our ODM business. So for the complete products which we make, our current mix would probably be ODM would be around 18% or 19% of our business. And the rest would be OEM. And we intend to take it to at least 25% in the next 1 to 2 year max. So that's the way forward, because ODM, as I said, gives us a better margin, and it's also a faster way to grow the business because now the product is completely ready and we can offer it off the shelf to our customers. So we see double benefit in increasing our share of the ODM business.
So basically, you're saying that the ODM business is primarily the fractional horsepower motors, which is there, right?
No, so FHP motor basically, like I said, that's an intermediate product. So we count it as it is 100% ODM business for us because the entire design and the ownership of the product is with us, and we sell it to multiple customers and the same product to multiple customers. So when I talk about ODM business, it's the complete finished product. So for example, a mixer grinder, an iron, or maybe a light fitting, or fans, what we do. So that's the ODM business where we want to increase our stake from the current existing 17-18% to at least 25%.
Akash, I was looking at your client profile, and uh, it's pretty much concentrated. Between the Philips group, you have nearly 48.5%. Signify and Philips separately, if I add together. How do you plan to reduce that concentration, because there's a very pretty high concentration that is happening?
Sure, sure. So, while your question is more specifically about Philips, what I would say is that if I were to look at a concentration for our top 5 customers, 2 years back we were close to about 75 odd percent. As things stand today, we are close to 60-65%. And it is a firm endeavor to bring this down, close to 50% levels over the next, few years. Just one specific point on the Philips Association. What we just want to point out is that there are 3 different legal entities, that are completely independently owned, with their own management team, supply chains, everything in place, that have the right to use the Philips brand. Right. So even though the Philips brand may account for 48%, but individually, no single company accounts for more than approximately a quarter, 26% of
Except for, I think, Signify, which is 26.8%.
Yeah, exactly.
And within that, you see that this share also going to come down below a quarter going forward as you
So
expand other
also,
area.
So also Signify also does a variety of product range, right? So it does lighting as well as fans. So effectively, what happens is that our lighting revenues as well as fan revenues come under one company. That accounts for a little bit of a higher optical number. But like I mentioned, it is our endeavor to bring down overall customer concentration. As we have succeeded to do so over the past 2 years, we will endeavor to do this also over the course of the next few years.
Mr. Sethia, you have a good exposure to the LED business because 31% of your revenues come from there. But what we have seen in the last 5 to 8 years is that LED prices are coming down continuously. And that also impacts margin. And one of the reasons it's coming down is also because contract manufacturing has happened, large scale manufacturing LED, and government's push, which is there. How do you maintain your margin under such a situation where end product prices are going to come down eventually, and it's going to become a commoditized business and in such a scenario, when you have a high exposure to this kind of segment, how do you manage that kind of outlook?
Sure. So, couple of we have a couple of strategies in place to take care of that. Of course, as the end prices come down, so do the input costs come down. We do a lot of value engineering in our products to bring down the price. That means in terms of the design, keep on working on the design, the LEDs, the engines, the drivers, the sourcing of the PCB. So it's not that we're just sacrificing everything from our margins. We are also working on the back end, pushing our suppliers, pushing our engineering team to bring down the cost, basically improving the efficiency of the product. So let me just give you one interesting example here. LED batten, which is a fairly commoditized product now. We had certain SMT machines in place, which would probably put, let's say, about 55 to 60,000 components per hour. We've upgraded that technology, and now we have a machine which does 150,000 components per hour. So basically, we've almost tripled the output and reduced the cost. So those are the factors which go in to reduce the cost, and then we ensure we maintain our margin. So, of course, yes, there's that push is going to be there, and then there are a lot of change in design happening. From your regular LED, you have co-extrusion. Earlier, you would have the housing would be different, the diffuser would be different. Now it's the component coming out in one go. You have driver on board technology coming up, which is already successful now in LED bulbs. Going forward, it will come in the LED batten. So there's a lot of back-end work going on to ensure that you can drive down the prices and still maintain your margin. The second strategy we are also doing is in the complete lighting sphere, we are also moving up the value chain. So we are focusing more on the connected lighting business. For Signify, it's the waste platform. There, the top line, the price per article is also high, and the margins are also better because there's technology involved. Not everybody can do it. We are also including streetlights in our portfolio, which again is a high top line, and plus, there is a you have to guarantee a streetlight for 4 to 5 years to a corporation. So corporations also want to go and buy products from very quality conscious customers. So their signifier scores. So we are moving up the value chain, and of course constantly working on our design and input costs so that we can retain our margin. And probably that is borne out by the fact that we've been able to do that for the last couple of years.
Does your business also allow for private labels to come out?
Could you come?
Does your business also allow for private labels to come out, your own labels to come out?
Okay, so you mean to say that selling end products in our own brand?
Yeah.
Okay, so as a company, we've stuck to our core competence, and our core competence is manufacturing. We are good at designing products, producing components, and doing the high level assembly. And as a company, we intend to stick to our core competence. We believe marketing and sales and marketing is a totally different ball game, which requires totally different skill sets. And of course, the minute you start, doing a brand or an end product in your name, your existing customers who are your strategic partners right now, they start viewing you as a competition. So as a company, we intend to stick to our core competence of manufacturing, and we have no plans in the near future of coming out with our own brand.
How about ODMs for other segments? Currently, it's in fractional motors and fans and mixers and others, but ODMs into other segments like LEDs or or any other appliances which are there. Are you looking at entering those areas as well?
Yeah, sure. So we are already doing ODM in the lighting business also, along with appliances, and our fan business is totally ODM. What we do is we start with manufacturing of motors for, let's say, a particular segment we are interested in. So I'll give you an example. We started manufacturing of fan motors, fresh air fan motors, table pedestal wall fan motors. And once we had established a name in that and we were supplying to multiple customers, we took that, because let's say for an appliance or a fan, motor is the heart of the performance of the product. It will determine the life and the performance of the product. So once you have the heart of the product is established, then you can easily go and pitch a complete product to our customer that, look, you're buying motors, why don't you buy the complete appliance? And that's the strategy which we are using to get into new segments. So let's say we are making chimney motors right now. When we are increasing the range of our chimney motors, and going forward, we are very aggressively studying the entire chimney market, and we are looking into the possibility of, let's say, getting into complete chimney manufacturing.
That would be through a player, or you would be doing yourself?
No, that would be through existing players, existing customers. So, a lot of our customers are currently importing chimneys and selling. So they are looking at, if they find a reliable supplier who can supply chimneys from local to local supply, they'd be more than happy to buy chimneys from us. So another area we've got into is the air conditioning motor. So we'll start with motors, we'll diversify our range of motors, and probably, that could be another avenue we look to then scale up and, forward integrate. So that's the strategy which you're using to.
The fan one is a relatively new one, right? With Crompton.
Yeah, so fan is
not old one.
The fan is about 2.5 years old. We got into fans end 2019, and we are almost doubling our turnover every year, and we have very aggressive plans to scale that up. And I think right now it's under the LED segment for us, but probably 2 years from now it's going to be a separate segment, which probably a pretty sizable revenues going to be coming from ceiling, the fan category.
Akash, you have your tie-ups with these clients, which are multi-year tie-ups. Do they have minimum offtake agreements as well?
No. So, there are no minimum offtake. How it typically works is, our customers present to us, at the start of the year, what they call an annual operating plan. That gives us an indication of what quantity they intend to procure, month by month. So that also helps us with internally resource planning and planning to meet those production targets. Given the fact that we have brand leaders as our customers and marquee names, who have very, very strong marketing and forecast and market research teams on ground. In our experience, what we've seen is that, the annual operating plan that they present to us and the actual offtake that they do from us is not materially different at all. I mean, historically, we've not seen more than a variation of 10 odd percent on either side. So we are fairly comfortable with this model.
And then how does it help you in planning your capex and increasing capacity going forward? If it's an annual plan, in that, how do you look at maybe 2 3 years how the scale up has to happen?
Right. So, like we mentioned, we work with multiple customers for most of our products. Typically, we look at investing in capex only once our capacity utilization sustainably starts hitting 85-90%. Right, because like we mentioned, these are all capacities on a single shift basis. So for temporary increase in demand, we have the ability to run additional shifts and serve our customers. So capex is seriously looked at only once our capacity utilization on a sustainable basis, probably 2, 3, 4 quarters, is hitting 85 and 90%. Only then do we look at capex.
Uh, does your business involve seasonality in any way?
I wouldn't say so, because broadly, if you look at our H1 and H2 revenues, H1 could be 47-48% instead of 50%. So nothing that is meaningfully seasonal. I mean,
Because there is some seasonality in consumer electronics. That's the reason I was asking.
So broadly, first half versus first half is similar. Within first half, generally Q2 is a little bit better. Within the second half, Q4 is a little bit better. But if you look at it on a H1 versus H2 basis, it's pretty much equal.
That brings to the next question, because your trade receivables have gone up in the first half of this year to nearly 35.3% of your revenues. It's been hovering around 23-25% over the last few years. Any particular reason why H1 saw a sudden sharp increase in trade receivables?
So in general, like I mentioned, in the run up to Diwali, the quarter which is July to September is typically the quarter before Diwali. Brands end up, stocking up before the festival, comes in, where they expect higher sales. So typically there is a little bit of a spike in debtors in the run up to the festive season, but that normalizes. Overall, if you look at our business, we typically operate at approximately 60 days of receivables. That's the number that we work with.
And what is the kind of inventory days that you may maintain at your end?
So anywhere between 30 and 40 days of inventory broadly, 60 days of receivables broadly, which is partially offset by 30 to 40 days of payables. So on a net working capital cycle, we are still at the net 60-day kind of cycle.
Sethia, you have applied for PLI, you have got one. What is the plan of expanding that PLI, and when is it going to get operational?
So in our business, we have got the PLI for a LED lighting area, and this was just a couple of months back. We will be investing around 10 crores in the lighting business. We've already started the investments in that. I expect this 10 crores to be invested in the next 2 years. I think we have a 2 to 3 year time period, and then get it operationalized.
So is it going to be existing facilities, or you have to create new facilities for that, right?
No, it's in the existing facility. So it's a PLI scheme is for incremental business. So you have to, on the base level, you have to give the documents that this is the increment which you have achieved, and then you get the PLI on the incremental part of the business.
What is the kind of revenue targets that you have provided to government for the incremental revenues?
So in our lighting business, we are at around, let's say, I think just pure LED lighting where the scheme applies, we are at around a 250 odd crores. So we are looking at a minimum increment of about 20% year on year.
Only, yeah. And this will be applicable for next 5 years or 10 years or something, right?
Yeah, that's right. So there's a ramp up to the PLI also, because naturally you invest and then the turnover also takes a while to ramp up the top line. So yes.
So the new land parcel that you're looking in Rajasthan and Noida, when do you see capex coming in for that, or setting up facilities coming in for that?
So right now, there is no firm plan, no firm timeline rather, I would say, for capex at those facilities. We are in the process of closely evaluating some new opportunities. And as and when we firm those plans up, we will decide to kind of put in money there.
Sanjeev and Akash, thank you very much for joining us on VQ Prime today. The Elin Electronics IPO opens on December 20th. Uh, Price between 234 to 247, fresh issue 175, and offer for sale of 300 crores by promoters and selling shareholders. It gives the company a market value of nearly 1,226 crores at the upper end of the price band. Thank you very much for joining on VQ Prime.
Thank you. Our pleasure.
Thank you so